can't think of anything else that is truly a hedge on bubbles. Cash, if it's in a strong currency, and gold. I mean, physical gold and silver. That's really the only hedge there is against bubbles. But plain fact is, gold has served people. For gold has served people, as you know. I mean, this is the essence of gold. It has protected people's wealth in many countries in many times throughout history. And it will do so again.
After struggling to find demand at the beginning of the week, gold turned north and reached its highest level in over a month, above $2,400 last week. As central banks embark upon a period of interest rate divergence, investors can also expect to see growing volatility in currency markets. The U.S. economy is on relatively solid footing heading into the second half of 2024. But while inflation has cooled, progress has been choppy and inconsistent. As interest rates move, currencies either strengthen or weaken, and gold is often used as a hedge against this. Adrian Day, the founder and president of Adrian Day Asset Management, points out that the current strong economy and robust stock market typically spell the worst environment for gold and gold stocks. So, the question arises, why are gold and gold stocks increasing in value? Day explains that this is largely due to significant purchases by national central banks around the world, particularly led by China, and substantial buying from Chinese consumers. Central bank gold purchases have stabilized at a record 28 to 30% of gold mine production since 2022, with the potential to rise to 35% in a bullish scenario. The World Gold Council's survey supported this view, indicating that 29% of central banks intend to increase their gold reserves in the next 12 months, the highest level since the survey began in 2018. Furthermore, the gold processing industry in India is projected to create 25,000 new jobs and witness about 15,000 crore rupees investments by 2030, a new report showed on Thursday. According to Adrian Day, he believes that there are few true hedges against bubbles besides cash in a strong currency and physical gold and silver. The plain fact is that gold has served people by protecting their wealth in many countries and at many times throughout history, and it will do so again. Let's delve into the video to gain further insights. Before we begin, consider subscribing to the channel and hitting the bell icon to stay updated with the latest content.
If you look at the macroeconomic environment, just look at it now. Don't look under the hood and don't look ahead. Just look at it. You've got a strong dollar. You've got high interest rates. You've got relatively low, we can argue, but relatively low inflation. 3.5 is a lot more than 2,
yeah.
But it's not runaway inflation. So you've got low inflation, you've got a strong economy, apparently, and you've got a strong stock market. That's precisely the worst environment possible for gold and gold stocks. So the question is, why are these things going up? And as you mentioned, there's the national central banks around the world, led by China, but a lot of buying from different central banks. And you've got Chinese consumers buying gold. Those are the two largest, on the plus side, those are the two largest demand sources for gold buying. And neither of those, Chinese investors or central banks, are looking at the macroeconomic environment as a reason for buying gold. They're buying gold for much more fundamental reasons, some of which you've mentioned. And so it's not, to me, and yet the Western investor, particularly the smaller investor, is indeed looking at the macroeconomic environment. And he's saying, interest rates are high and inflation's low, I don't need gold. He's saying the stock market is strong and the Magnificent Seven are, well, they're Magnificent Four now, but anyway, they're magnificent. I don't need gold stocks. So on the surface, it seems sort of very peculiar, but we're seeing these outflows from the ETF, yet gold going up. And yet, to me, there is a rational explanation. It's not totally irrational. Now, again, if you look under the hood and if you look ahead, then I think, these things are going to change. They're not all going to change dramatically, or they're not all going to change immediately. But to me, the U.S. economy is definitely slowing, and that just adds pressure on the Fed as well as other central banks to lower rates. And as you know, many central banks around the world are already now, after raising rates, are now already on the rate cutting cycle, including Canada and the ECB, European Central Bank, as well as many smaller countries. So, the Fed is going to follow. Inflation, I don't think, is under control by any means. I think we're going to see the CPI numbers, at minimum, they're going to inch up. At minimum, they're going to be stubborn. We're not going to get down to 2%. Slowing economy, lower rates, higher inflation, and now you have an environment that's actually positive for gold. So, and the market is forward-looking. As a contrarian, I'm a little bit, frustrated that people are continuing to sell gold. It's one thing if they're not rushing into it, but the ETFs are continuing to sell gold.
Despite the price of gold hitting a new high, gold exchange-traded fund investors appear to be shunning the investment opportunity as major global funds have witnessed sizable outflows since the beginning of the year. Global physically backed gold exchange-traded funds have lost $6.7 billion in the first half of calendar year 2024, suffering their worst first half in a calendar year since 2013. Total holdings, the report said, have dropped by 120 tons to 3,105 tons during this period. North America, WGC said, saw outflows of $4.9 billion during H1, the largest in 3 years. However, a 13% rise in the gold price during H1. European funds, too, saw their worst show since 2013. Despite a 6% fall in holdings, WGC said, the total AUM of European funds saw a 6.3% rise during the first half, thanks to the higher gold price. Adrian mentions that the gold price is rising despite outflows from gold ETFs. This phenomenon also affects gold stocks, with the GDX and mutual funds experiencing outflows, which Day finds puzzling. Now, let's redirect our attention to a video.
The first thing I'm looking at is, first of all, some of the things that are driving gold. And as you know, and I'm sure most of your listeners know, the most interesting thing to me is that we've got a gold price that's moving up, and yet we've got outflows from ETFs, both in North America and in Europe. We're seeing steady outflows. Even throughout June, we're still continuing to see these outflows. The same phenomenon is happening with the gold stocks. Of course, the GDX is seeing outflows. Mutual funds are seeing outflows. So that's a puzzle. So I'm looking at that. We can discuss that if you want. The second thing is, the economy, particularly in the US, but the economy in general. And I think the economy in the US is in a far worse situation than the headlines suggest. I think we're moving towards a recession. Inflation is not under control. So there's a difference between reality and perception, or perception and reality. Headlines on most of the things, and the same goes for the stock market. So I look at that as well. You look at the stock market, the S&P continues to go up. The S&P is strongest, the US stock market, strongest stock market in the world this year, continue to go up. And yet 50% of the gain is a single stock, which, however great that company is not a healthy stock market. And we're getting more stocks with 52-week lows than we are with 52-week highs. I'm not a sort of market technician, but that is a bad sign when the market is moving to new highs, and yet individual stocks are making new lows. So the breadth in the market is very bad. So again, just as with inflation, just as with employment, just as with the economy in general, there's a difference between the headline, and then if you look under the hood or look under the bonnet, which is what we do in England.
That's right.
It's a little more nuanced at best, and a little more negative situation. So that's the second thing I'm looking at. And the third thing, which probably is of less interest to you, is the gold stocks, which are just stupidly cheap.
The 2024 outlook for gold is apparently bullish at the moment, supported by strong physical demand, strong central bank purchases, and potential shifts in monetary policy. Central banks, led by Turkey, China, and India, have put a floor under the gold price in the face of outflows from exchange-traded funds in the recent past. The sector uses gold as a dollar diversification play, making it popular in nations with large U.S. currency holdings. China bought the metal for 18 months straight before pausing in May, according to data from the International Monetary Fund. Do you think the recent actions by central banks, particularly in China, will continue to support gold prices? Feel free to share your thoughts in the comments. If you found this content helpful, give it a thumbs up and remember to subscribe to stay updated. Thank you for being a part of this journey with us.